So setting context for this panel discussion, I think the agenda really was to discuss an optimism index for 2020. I'd say there's optimism all around across multiple sectors, etc., and how I wanted to gather a sense. So if you look at the last couple of years, if you look at deal tallies in the last couple of years, we've had a few great years. The last year perhaps saw a slight dip in volumes in terms of the deal space, but an interesting perspective, especially considering people sitting here. For a growth investor, the quantum of deals that are there in the market, the size of the deals is very different. Whereas the same deal tally, if you start looking from early stage and venture capital investors like the two on the dais today, their vision and their view of the deal tally and what is it that lies in the future is probably very different. So I'll probably come to you, Vishal, first. From a deal index perspective, the number of deals, quantum, the average ticket size. What's your view of the trends in the last 1 year? There has been a slight dip in the volume. And what do you foresee in the next couple of years, largely from a growth investor perspective?
So if you look at last year, I think while I was not aware of this statistics that a little bit deal volume has gone down, because overall the deal flow that we have perceived during the last, I would say 12 to 18 months have been quite robust. And if I look at our deal pipeline today, it looks very robust and some very good transactions, though of course, the two things which could be driving the volume a little bit down. One, there has been an uptick in valuations. So this could be making investors a little cautious before taking a call. And that could be also resulting in certain deals getting negotiated over a longer period of time and some delay in closure of the transactions. And secondly, specific to growth equity, some of the funds have not been able to raise next fund. Or what is happening is, funds which are large, they are able to raise funds and they are raising a larger size fund. So for example, Kidara, multiples, Chris Capital, there are multiple of them. And as the size of the fund goes up, you tend to do larger ticket size transactions because you want to limit the number of transactions in the fund. And it is possible that some of the smaller size funds have not been able to get the same traction from the LP community. So it's possible that some of the smaller size deals, which in a normal scenario would have got done, might not be getting done. And also a little bit, I think it's could be doing investors being cautious because of the valuations being where they are.
And coming from either of you, probably you to start with, a web of...
But your second part was, how do you see the deal flow going forward? We feel very optimistic that as the economy grows, there will be opportunities across multiple sectors. And also there are opportunities where a lot of money had got invested in last few years. Some of that money will come for exit. So there would be opportunities on the secondary side also. So I personally remain very optimistic about the deal flow and the positivity around the deal. And if the economy continues on the path, I think private equity is headed for very good times in India in terms of the quantum that can get invested.
For adding that, I think that's a perfect dovetail because honestly, I agree with what he says. I think very optimistic. I think I do agree that new company formation and just buzz in the market, at least at the early stage, right? That's sort of the stage we are focused at, has gone down a little bit. But I think that's a great thing for two reasons. One is, I think venture capital fundamentally is a business of picking outliers, right? And, we strongly believe that, in a country as large as India, seeing as much activity, there will be 5 to 10 to 15 strong companies, category-leading companies, hopefully, $500 million to $1 billion companies in the next 5 to 10 years. That'll get started now, right? So in fact, we invest more feverishly. We've invested much more feverishly in the last couple of years than before. And the only other thing I'd add is, I also think that having been a founder myself, I feel some of the more bearish times, some of the more cautious investment environments favor people who are really mission-driven and building businesses they believe in, because it really culls competition. a lot of sort of tourists and people with sort of copycats don't really get capital thrown at them, and therefore you have the luxury to iterate, to learn, to take your time and really get the model right. I don't know if Sanjot would agree with me.
Is that any different for you, Sanjot, in terms of your view? I mean, Matrix has been continuously doing deals, but have you seen a slight dip in the investments, and what's your outlook at the next few years?
So the short answer is no. I agree with these guys. I think to the first part of your question, looking back, I think there was this anomalous behavior, at least in 2015, 14 perhaps, where there was a lot of money that flew into India, into private investments, early stage as well as late stage. There was a lot of company creation. Both of those, I think, were somewhat opportunistic and perhaps not very long-term in nature. So you can't look at those couple of years and say, there were 5,000 companies or 6,000 companies created, there were hundreds of deals done. That's not necessarily the norm. I think there are these sort of points in time when certain sectors, certain countries, certain geographies are sort of quote-unquote hot in nature, and there will be more deal flow, there will be more company creation. But I think what you have to look at is the actual sort of quality of entrepreneurs, the quality of opportunities in terms of investments and deals, and that, I think, most investors will agree is better today than it ever has been. As an example, we, in our 12-year history, made the largest number of deals last year. And I know that's true of a lot of investors where they're looking for quality deal flow. And I think looking ahead, that's what gives us a lot of comfort, that we're seeing great quality entrepreneurs coming back to India, starting in India. And even at the growth stage, we're seeing a lot of sort of true value creation, whether it's in the form of IPOs or whether it's in the form of large profitable companies being formed as a bellwether of where we can invest. So I think positive outlook. And we shouldn't let some sort of almost a false negative fool us into believing that there's something that's at play that shouldn't be.
Okay. So that's optimism for sure for the next few years. An important discussion we were having, and I could really never get all three of them on consensus, is a lot of the deals that you see, a lot of investments that you see are based on, they're riding big on technology. But the definition of technology that I saw across each of these esteemed panelists sitting here was very different. From a growth investor, what is the role that technology plays in the business when they are evaluating a business? From a largely tech-focused investor, how significant would he want technology to play at the time of investment as well as in the long term? And from a continuous regular investor and very successful one at that, how would you view as technology? So I'll start with the perception of Vishal. From investments that you've looked at, from any common investments that you have, how great a role does technology play in you evaluating an investment?
So we typically tend to invest in normal sectors like financial services, consumer, which are more brick and mortar businesses. So per se, technology as such is not a very important criteria, but more and more we are realizing that in every business, technology is becoming important in terms of efficiency and in terms of driving better efficiencies and making your processes more smoother. So for example, today if you look at broking business or financial services, especially broking or exchanges, they are nothing but a very, very strong bedrock of technology. So to that extent, one has to be, so the thing that we focus more on is whether this entrepreneur will remain at the cutting edge of the technology, and would he have a mindset to keep evolving the technology as the business will demand it. What we don't do and we don't invest in are the companies which are highly technology oriented and where the technological evolution could result that if someone is not able to catch up, will be totally competed out. So for example, there could be different softwares in retail financial services. Someone could use one and someone could use other. But someone whose technology is little inferior may not necessarily be totally be competed away completely. You can still have a robust business based on certain other parameters. But so if, for example, we had invested in a domestic call center company, eventually it was an inbound call center when we had invested, They were converting themselves to an outbound call center. The business couldn't scale up, and we didn't have much understanding as how the landscape would evolve. So we have now tried to refrain ourselves from investing where technology can be a complete disruptor. But that being said, technology is a very important aspect of making any business competitive.
So technology not being a disruptor, that's probably keyword. A completely divergent view is what I'm expecting from you, Vaibhav.
We were having a passionate debate about this, so with all due respect, we have a slightly different view of the world. I would say, number one, we think technology is a great friend of both the founder and the investor. What does technology do for a business, right? Technology really helps you scale without having to scale your costs. So it really builds operating leverage in the business. A lot of marketplaces that we bagged. Incidentally, we both investors in Indian Energy Exchange, and even then we don't have the same view on technology. I mean, is a business which was 40 people when we invested in 2010, and sort of 2017, it's about 80 to 100 people doing close to 180 or 200 crores of PAT. That for us is an example of how you can grow business, grow throughput without having to scale people, offices, utilities, what have you. Second, I think technology, again, sort of on the vein of why is it a friend, I think especially in a market like India, Vrinda, where there's a lot of offline execution challenge, technology really helps you scale without having more and more points of failure. So compare a company where it's growing 2x, 3x, on say a digital product versus a company which is opening more outlets, more manufacturing units. You need more people, just more points of failure. I would say the second thing on technology is we've seen time and again in India and as well as in the US, dramatic value creating opportunities become apparent when technology shifts. An example is Uber, right? Uber became possible in the US because there were smartphones, there was mobile, there was a map infrastructure, and there was location available for everyone. Absent that infrastructure wouldn't have been possible. We're seeing similar opportunities in India with what India Stack is now building for Aadhaar, which is, whether it's digital verification, whether, just everybody having a unique identification. I think a lot of these are really tech stacks that make businesses, possible. Artificial intelligence, IoT, I mean, we can chat at length, but I think our view is that when technology shifts, a lot of new businesses get enabled in a very profound way.
Sanjot, from your perspective, you've invested in brand-oriented businesses as well. So it's probably an interplay of the brand growing by itself and technology also sort of playing a role in parallel. What's your view in terms of an investment criteria and the role technology plays in any of the businesses that you've looked at? And some of them are very technology dependent and oriented.
Sure. So I think our view is somewhere in between Vishal's and Vaibhav's. So if I take a step back, the core of our investment thesis is being in business with the best founders and entrepreneurs in India. That's it, period. And if we can achieve that goal, nothing else matters, whether it's tech, non-tech, whatever else. That being said, in terms of evaluating opportunities outside of looking at the founder, we want to build businesses that are impactful and can get meaningfully large and can impact people's lives in a positive way in the long run. Now, I know that's a fairly sort of ambiguous definition of a business, but what that means is that going forward, we want to invest in businesses that are both offline, online, technology-enabled, non-technology-enabled. But increasingly so, we find that most businesses in some shape or form will have technology either as an enabler or perhaps as a core to their business. It varies. So consumer brands today are using technology ERPs for their say supply chain optimization, or using the internet to sell more. So there's distribution that's tech-led. On the other end of the spectrum, you have software businesses that are completely technology-based. But both those businesses fundamentally can impact people's lives in a large-scale manner, and therefore can become very, very big companies. We had W, which was an apparel brand using technology in its supply chain. And we have Ola, which is an app, arguably, you could call it a taxi company or you could call it a tech app. So point being, the sort of filter of tech versus non-tech is somewhat artificial or is becoming artificial. I think technology will be core to all of our futures. But as long as you're in business with the best founders, I think they'll figure out a way to build the best businesses.
That brings me to the next question. You having brought it up, identifying the founder, finding the best founder and backing them. We've heard stories, all of us have heard stories where people have bet on businesses, etc. Do you very often face difficulty in dealing with some of the founders? Does their mindset, so it's very different when you're evaluating them. You're really looking at the most entrepreneurial of the same, with the greatest idea, with a heady mix of technology versus, and let's say a consumer or a brand. But any challenges, any others that you would share, that probably an investor who's looking at evaluating investment should be on the watch out for, and also an entrepreneur should be able to realize from examples, experiences, what he should be mindful of, and what's that something that the equation that needs to be maintained from, and any challenges that you particularly face on that. We've read the one in the papers and in the magazines separately.
Sure. So I think all investors who've been around long enough in India have gone through challenges of put broadly, corporate governance of some sort. I don't think corporate governance laws in India are the strongest, and there is, widespread issues that go along with that: embezzlement, corruption issues, so on and so forth. So there are some systemic issues I think we all face. The positive side of that is that I think increasingly it's getting better. Again, going back to the best founders, I think the best founders always, when you're talking to them, evaluating them, looking at the history of how they've led their lives, show a long-term orientation. And anyone with a long-term orientation tends to be sort of more transparent in nature, values the benefits of corporate governance laws. And at the end of the day, it's more of a gut call, especially for us as early-stage investors. But I think it is improving for sure, both from a systemic perspective, where the government is coming up with better laws, but also entrepreneurs realizing the value of it. But I think then there's also a human element, right? Human beings are difficult to deal with, myself included. And if you look at the best founders, they're even more difficult to deal with, even around the world. You pick any example, whether it's Steve Jobs or Mark Zuckerberg or whoever else. I think smart people, capable people are strong-headed. They have very strong points of view, and we wouldn't have it any other way. The kind of investor that we are, we don't take operational control. We sort of back the founder fully, and we do advise them on strategic issues, but the call remains with the founder, which is why that thesis of being in business with the best entrepreneurs matter. Because at the end of the day, you're trusting them to do the best thing with the company, and they're not going to listen anyway.
Vishal, do you face the same when it comes to relatively larger, more evolved businesses? Is that something that you sort of stay away from, or do you foresee and regularly see promoters still pushing a certain agenda? Would you let them be, or would you sort of intervene? And
I would like to break this thing into two parts. One is the part around the governance, whether they are trying to take out money and all of that. And secondly is, what is their view about the business? So I will give you an example. We have a road EPC company in our portfolio. Now the promoter was very clear when we were investing also, that finally what would be the bid, that is my decision. And I have been on the board now for 7 years, and I have respected that aspect for last 7 years, because there is nothing value add I can do about how and what he should bid for the road. That is his expertise. I wouldn't even know from where to start. So now I can say that he's very strong-headed, and in his mind he could have won some tenders, or he may have not won some tenders. But it is not right on my part to say that that aspect is a difficult aspect to deal with, because that was the expertise for which we invested in that company to begin with. Now, we cannot come and think that we are better experts in that and try and, now, of course, you can discuss with him, let's build a team, we should have a more process orientation around tender. And he listened to all of that they made up a process, that all the tenders that are coming and all of that. So that is more smoothing.
But let's say a difference in perception. You're pushing them towards improving profitability, them targeting growth, more and more tenders,
Yeah, so
etc. Do you face that often?
Yeah, now the other two aspects come is when you are pushing towards profitability. In certain aspects, many of the promoters are more focused towards profitability than what you would be comfortable with. And their view is that we are in this business for long. You guys are only with a shorter duration. So I think that is lesser of a conflict. Conflict arises more where a promoter is more focused on spending money because he thinks that's the better way to build business over the long run. And as an investor, you are focused on year kind of a number. So in one of our portfolio company, we had that kind of a difference in opinion. But I wouldn't call it a conflict situation. It has been more of a difference in opinion. But over the last 1.5 years, both of us have realized that it is important to focus on cost. And now they are saying that whatever cost we had to incur, we have incurred. Now we will be focused on cost. So it is more of a timing difference. But eventually, I think every entrepreneur would be focused on profitability. Every entrepreneur would be focused on growth. Now people can have a little different perception of the timelines. But the third and the challenging aspect is when you realize that you are with somebody who is not transparent. Thankfully, so far we have encountered only one such situation where it was a complete case of fraud and all of that. So but we were very clear that it is our responsibility towards our investors, while that investment would not have amounted any difference to the fund. But we have been pursuing that matter with all earnest. But sometime if you are in that situation, beyond a point, I don't think so you can do much.
How would it be very different in a startup or an early stage company? What would you push them for growth, profitability?
So I think I'll caveat that by saying it depends. And I agreed with Sanjot that ultimately the decision lies with the management. I think we play the role of a responsible board member to ask the hard questions and then help them get to the right answer. We might even have the wrong intuition. But I'll give you a couple of examples where it's not very clear what you do. I'll give you an example. Let's say you were a GST. All businesses adopting GST. Let's say you have a product which is say a tally analog, right? Helps people file GSTs better. Now your cost of acquiring a business is, let's say, 5,000 rupees, right? But the business is not ready to pay 5,000 rupees, right? Now, do you discount pricing and then hope to get massive distribution? Or do you say, no, charge 10,000 so you have 50% margin, but then you're shrinking the market, right? I have a view on it, but I think the answer is different from, say, healthcare, where I think about this. Let's say there are 2 technology products where you could go and two marketplaces where you could go and consult a doctor on an app. When was the last time you went to a doctor because he was giving you a 50% discount? Almost never. I might buy a mobile phone if I'm getting 50% discount, but not healthcare. So I think categories sometimes dictate, pricing and profitability versus growth. The second characteristic would be winner take all markets, right? So marketplaces where certain scale is important to get to tend to be more growth oriented than pricing oriented. Case in point, Uber, and I'm sure Sanjot can talk more about Ola. I think where the challenge comes is when the priorities of growth and early stage investors are sometimes different. Let's say we're an early stage venture capital fund in a business and the founder is 23-year-old, 1 year out of IIT, building a consumer business. And we're like, holy shit, you were minus 20% gross margin, you need to sort of move levers in this business to break even. But then a hedge fund wants to come in the next round and wants to sort of dominate the world. As a 23-year-old founder, sometimes that can be disorienting. And I think that's where sort of some of the more sort of nuanced challenges we've seen. But I think enjoyable and sometimes frustrating. But I think those are the challenges where there's no right answer, and you have to hopefully engage in a conversation. What
would your view be, Sanjay? We're running very short on time, but I'll probably conclude with your view in terms of driving growth, profitability. What role do you take in as an investor in some of these really great names that we're hearing of them now, but we'd probably not heard when you were investing? What stance do you adopt, and what would you recommend, from a longevity perspective?
Sure. So I think it's similar to Vaibhav's view. There's no one size fits all. Again, if you look at it holistically, every company sort of goes through an S curve, right? So and different investors invest at different times in that S curve. So as an early stage investor, you're very early in that S curve where it's supposed to be somewhat non-linear, upwards and to the right, hopefully, for most of your investments. And then for a late stage investors, it slows down a little bit, and then you have public markets where, there are turnaround situations, there might not be too much growth, it's more about profitability. So point being, by definition, as an early stage investor, you are looking for growth. Growth cannot be compromised for anything, right? Now the question is, what is that growth? What is the cost of that growth? How much are you willing to burn for that growth? And that comes back to the industry that you're in, the kind of product that you're developing. At the one extreme, you have sort of the tech-led, very, very disruptive products where, you have to capture the market, or you will just lose. It's 0-1 outcomes, as they say.
Share something on the brand side with us. Any example there?
Sure. So and then somewhere on on the other, not perhaps on the other end, somewhere in the middle, you have the consumer brands, which frankly I'm very, very bullish on. I think the priority one for us is getting product market fit at our stage of investment, which is, simply put, you have a product that you make for a few cents, as Warren Buffett puts it, sell for dollars, and is habit forming. In other words, you have high gross margin and people love your product. That is priority one. And then priority two is, selling that as quickly as you can and getting as much growth as possible, and then hopefully becoming a profitable business. But these businesses tend not to be binary. They're not 0-1. Some of them will get to 100 crores, some will get to 1,000 crores. But if you have an excellent product, I think profitability is only a matter of time in consumer brands, and especially if you build it the right way. It's technology enabled on the back end and the front end. But I think the fundamental need for more consumer brands in this country is very, very real. On the one hand, our GDP per capita is still below $2,000. But on the other hand, we have 400 million people on the internet who look at, what Sonam Kapoor is wearing the same day as she's on the red carpet, but have no way of buying that same dress. So for us, it's bridging that access aspiration gap, as it were, where consumer brands really fit in. And if you can make an aspirational, high quality, accessible and affordable product, the kinds that, some entrepreneurs were on stage before us, whether it's White Rhino or Viva or others, they're doing exactly that. They're making very good, high quality products that are accessible and affordable. And I think that's the way future.
Great. And from, coming back 2020, any sectors focus that each of you are looking at? Any,
So
from a
we
growth
continue
and
to
startup
remain
perspective?
excited about financial services, consumer, like he mentioned brands. We also feel that there is a lot of shift happening from unorganized to organized. So that is one theme we are very dominantly trying to play, and we think with GST, perhaps that shift will be further accelerated. Similarly, in financial services, again, the same thing. The access to financial services is very important. And then third, we still are very bullish about pharma, especially domestic formulation, and some very niche manufacturing opportunities. So, like to give you an example, we had a portfolio company in our fund, first fund, Dixon Technologies, which is into manufacturing of consumer durables. How that company has been received by public market and how the stock has done since listing has surprised us. So one learning that we think from there is that while we all talk about sectors and all of that, there are certain characteristics. So the company is cash generative, it has high ROCE, it is showing good growth, it has a very healthy balance sheet. So market is rewarding it for it. Eventually, whichever sector you may be, there are certain characteristics which will get rewarded in terms of value creation. I think more important is to focus on that aspect.
Does that differ for you from an evaluation perspective?
I would agree with some of the things. I mean, so for example, pharma, we haven't done much of, so I guess just different focus. But if I was to answer your question, I guess I have a sense of what you're looking for. I would say three things. One, I would say, with geo and mobile phones, just the opportunity to build content for the next 100, 200, 300 million people. And Sanjot and we are investors in a couple of these companies, invested in Clip, we invested in ShareChat, are behind this thesis. I mean, in 1 year, YouTube went from 40 million daily actives to 150, 160 million daily actives. Today, India consumes more data than the entire United States and China put together. And these are massive inflection points. Going back to again Sonam Kapoor on a smartphone, that's the reality. But these people don't speak English. They cannot go to Flipkart and order a product. They can't even go to Make My Trip and order a whatever railway ticket or what have you. So just transactions and content for these people is going to be one. I would say second, GST has really opened up two opportunities. I think one is logistics. So completely broken $8 to $10 billion market in this country. And I would say the other is small business. A lot of businesses who've been completely offline, you just don't know how much business they do, what business they do, somebody says ABC Enterprises. No bank knows how to lend to them. So I think a lot of businesses are coming online. I think small business and logistics gets a fillip. And I would say the third is, sorry, I'm blanking out. The third is fintech. So I think just we're hoping with some of this stuff around India Stack and with Aadhaar, will really enable financial inclusion and create interesting access opportunities around fintech.
Sanjay, do you see deal flow being active enough, etc., enough deals flowing in for the next few years? And what is it that you're evaluating? And if there are any interesting opportunities that you would want to look at, which sectors particularly?
Sure. So I think it's the quality of deal flow never ceases to amaze me. I think the quantity has, like we were earlier discussing, has probably gone down a little bit, but we're probably at a steady state. I was just looking at a stat that there were about 2,000 new companies created in 2017 versus 6,000 or 5,000 odd the year before. I think that's not very worrying because what matters is the quality of opportunities, and that's still very, very good. In terms of sectors, like I said, consumer brands is a big focus area. Within that, we're very bullish on fashion, FMCG, personal care, and then of course, financial services. All of us realize there's a big access opportunity, so we're also going after that. In media in particular, I think the confluence of sort of the local language user, which is going to be, 9 out of 10 people coming online today don't speak English. And by 2022, 80% of India's internet population will not speak English. So you suddenly have 600 million odd people in 2022 who don't speak English, but have, almost unlimited internet access. And most of them are yearning for, high quality content or entertainment of some sort, Even today, if you look at your drivers or whoever else on the street, everyone's watching videos. But there isn't enough content to cater to 600 million people. So we're very bullish that there will be content platforms, whether it's user-generated or professionally generated, whatever it might be. But catering to that sort of local language user in tier 2, tier 3, and tier 1 cities, we're very, very bullish on. In terms of what we look for in entrepreneurs, I think that doesn't change. These entrepreneurs need to understand the consumer better than anyone else. The product needs to be, if not game-changing, but needs to sort of rise above the gluttony of everything out there, because there is a lot of brands, there's a lot of media brands, and so on and so forth. So you need to be distinguishable, not because of your marketing or advertising, but because of your product. And I think a combination of the best founders with the best product is magical.
Optimism, I'd probably say at its peak. I think what is consistent across trends that we're discussing, there are interesting ideas, there are interesting products, technology is playing a very large role. And there are investors sitting across multiple who are evaluating different businesses as we speak. I'd say a deal tally for the next couple of years is likely to be extremely healthy. Technology really will play a very large role, and you'll see disruptive businesses coming into the market, completely game-changing for all of us. So I'd just like to say thank you to each of the panelists, and also try not to hold you from lunch, which all of you seem to be waiting for as well. Thank you very much.